Historically, it has been positive for stocks once the market kind of makes its peace with a new threshold in yields. I mean, you could just demonstrate that. You go back 2 years, the 10-year Treasury yield was at about 1.7%. Now it's at 3.25. Market over that span is up more than 30%. So obviously, if the conditions are right, stocks can do fine in this environment. And right now, it is real yields that are going up for the most part. It's not just inflation expectations that are rising. So that's actually kind of good. That does relate to growth rates in the U.S. I do think, though, that you can't get away from the fact that it does pressure stock valuations on some point. It raises the cost of corporate credit. It obviously knocks some companies out of the financing box and all that stuff. That's why I think on a sector basis, there's a lot of give and take here. What are some of the wrong reasons, though, it could be going up? If there's a perception that it's a supply-demand issue, that basically China's buying less and there's a lot of treasury issuance, or if because of foreign exchange is very expensive to hedge out dollar risk right now, so global investors are less able to just buy treasuries and capture that yield spread. That's all mechanical kind of capital markets noise, and it doesn't necessarily compensate you for the fact that the cost of money is going up. So we've had this in the past. When we crossed above 3%, the stock market took the opportunity to back off. After Fed meetings, the stock market kind of backs off a little bit when we get a hike. So all this is pretty much in tune with what we'd expect, but there's kind of no way to get away from the fact that as rates go up, it does put one element of pressure on stock valuations.
I think it's that there's a feeling we're underestimating wage pressure. You look at
it could be that, right? So it's anticipating more inflation.
It's so tight, 3.7. People are still saying that the workforce is still participation rate is low, all that, and then we can get more workers from there. But there's more and more industries you're starting to hear can't get the workers that they need.
And small business optimism. What we just heard from Kate Rogers earlier last hour is that it's still the number one concern is the quality of the labor that they're able to hire.
Right. So you have that premise, but also there's a sensitivity to the idea that into 2019, there's at least a risk that the economy decelerates. Whether it's true or not, that's what the market is kind of watchful of right now. And I think if the idea is, okay, now we're at 3.25 on the 10-year, housing market's already kind of slowed down. Are we going to be slowing into this situation where the Fed is still determined?
We're supposed to, we're going to talk to our guests now. One of them brings up the point, good news is bad news again. So that,
it's mixed at least. Yeah.
Well, if we go to where it just moderates a little, wouldn't that would be Goldilocks again? Just right.
Right. It's not far from Goldilocks, right? You could moderate. You could have the Fed change its tune slightly and just inject that idea that they could pause back into the market, and we're kind of back where we were.
Let's bring